They're actually in very good shape. Many of them have been paying down their debts. They've been upgraded. They have rainy day funds and reserves, which is great.
Veteran portfolio manager Robert DiMella explains why munis deserve your renewed attention.
Funding provided by ClearBridge Investments, the Fairholme Foundation, First Eagle Investments, Bill Miller, Baird, Strategas Asset Management, Research Affiliates, Royce Investment Partners, Seafarer Capital Partners, and Women Investing in Security and Education.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. I am amazed at the equanimity with which investors are digesting some pretty significant events. We've had a government shutdown with all that entails, from layoffs to closures to flight delays. In September, the Federal Reserve cut its Fed funds rate for the first time this year. The benchmark short-term rate was lowered a modest 1/4 percentage point, but the Fed is signaling there are more rate cuts to come before year end. And gold is trading at record highs, having surpassed the $4,000 an ounce mark in early October. In what's being called the debasement trade, investors are reducing positions in securities denominated in dollars, which they believe could depreciate further this year. Instead, they are buying gold and other alternative assets. Then there is the normally staid $4.3 trillion municipal bond market, where individuals invest for tax-exempt income. Munis, which are largely known for their reliable income and performance, have had an unusual 3-year stretch of volatility. It started with 2022, the worst year for bonds overall in decades, if not ever. Munis lost nearly 9%, a shocking decline, but still better than taxable bonds, which fell 13%. 2023 saw a nearly 6.5% rebound, but not enough to make up the difference. Same with taxable bonds, which lagged with a 5.5% gain. Last year, munis and bonds in general barely eked out a profit. And so far this year, the 2 2/3% advance for munis have badly lagged the 6% plus gains in taxable bonds. So since 2022, investors in munis have barely broken even, and taxable bondholders have lost money. Why have municipal bonds performed so poorly, and is there any reason to expect a better outcome? Joining us is Robert DiMella, a veteran muni bond manager. He is co-head of Mackay Municipal Managers, where he oversees $80 billion in assets. He is portfolio manager of the New York Life Mackay Municipal Bond Funds, where he specializes in investment-grade munis and special situations. Among the 8 funds he manages is the nearly $9 billion flagship NILE Mackay Tax-Free Bond Fund, which he has managed since 2009. It is rated 4-star by Morningstar and has a bronze analyst rating. I began our conversation by asking DiMella why muni bonds have performed so poorly since their promising rebound in 2023, when he last appeared on Wealth Track.
The municipal marketplace has struggled a little bit with a higher supply environment over the last couple of years. As a matter of fact, in 2024, we had record issuance for the first time ever over $500 billion. And so whenever you have a heavy supply, that tends to weigh on the relative performance of the marketplace. So in 2024 and 2025, it's trying to kind of continue to recover from, quite honestly, going all the way back to 2022, as you had highlighted. But if you really look back at in 2023, all of the performance was the last 2 months of the year. We put in like a 5 to 6% return that year.
Right.
The vast majority of that with just the last 2 months of the year when we really recovered. So it's the environment we've kind of been in for about 3 years now, which is a constant question we're getting from investors asking, why? What's going on? And it's largely that technical landscape. We're just dealing with a lot of supply that our marketplace just has to absorb on a regular basis.
Why is there so much supply?
The supply is higher this year for reasons coming out of mainly Washington, D.C. There's a lot of uncertainty with regards to policy. As an example, until the big, beautiful bill was passed into law, the municipal marketplace was worried whether they were going to get their tax-exempt status stripped. Meaning issuers didn't know if they were going to be able to issue a tax-exempt bond. They might have had to come to the marketplace as taxable. Now, our team here at Mackay Municipal Managers, we didn't think that risk was really high, but some issuers thought about it, and so what they did was they front-loaded their supply. We had a lot of supply coming earlier in the year, specifically before this big, beautiful bill came into existence. And that, coupled with the fact that demand really wasn't going out on the long end, kept the municipal marketplace up through August under a little more pressure than not versus our other taxable market counterparties like the Treasury marketplace and the corporate bond market.
The municipal bond market is supposed to be kind of resilient, staid, just, reliable. Is volatility here to stay, or is that kind of a new characteristic of the municipal bond market?
We actually do believe volatility is kind of here to stay. It was always kind of here, but as you had pointed out, there's a distinct difference when you're talking about volatility that is technical and temporary and fundamental and long-term. So we think it's really important for investors to kind of see through the volatility. Don't worry about it as much, because at the end of the day, when you're under volatility and yields, as an example, go higher when prices come down, it's a great opportunity to continue to rebuild your portfolio, attain slightly higher income streams, because it is just temporary pressure that the marketplace is coming under.
Something that we also hope is temporary, but I'm wondering if it's weighing on the municipal bond market is, we've got a government shutdown. How is that factoring into what's going on with munis?
So the municipal marketplace is having to grapple with the federal government kind of pulling back on their expenditures and outlays anyway. The federal government was in a position, and it's not just going back to the pandemic, it's going all the way back to the great financial crisis. The federal government started in the great financial crisis in 2008 of basically opening the spigots, opening up their cash flows and supporting everything under the sun. But now the environment's getting back to where the federal government is kind of pulling back. And so the state and local governments are kind of stepping up on their own. First of all, it's happening at a time wherein they're actually in very good shape. Many of them have been paying down their debts. They've been upgraded. They have rainy day funds and reserves, which is great. So even if the economy continues to slow down, they have a lot of resources at their disposal to take advantage of this. It's no different with regards to this shutdown right now. The states kind of knew it was kind of coming. They're prepared for it, so to speak, but they do have to work at it. The longer it goes on, the more it may impact the economy and therefore tax collection revenues.
I'm intrigued by the fact that you said so that the finances in state and local governments are actually improving. Is that right?
Yes, they are in pretty good shape. They had been improving. They're kind of going sideways recently, but you have been kind enough to have me on your show on several occasions, and there's a couple of states I highlighted that you really have to worry about. Illinois, New Jersey, Kentucky are three of them that kind of from a financial perspective had to do a lot of work on them. Almost all of them had been upgraded into the A-rated category. Illinois about 4 or 5 years ago was flirting with going to non-investment grade. And so it's a very different landscape today, and it was a combination of, yes, they had federal support coming out of the pandemic without question, but they also the economy was stronger than before. Inflation that was elevated actually creates higher revenues for state and local governments. There's embedded inflationary hedge in municipal credit and finance. And so all of these elements have contributed to the municipal marketplace from a fundamental credit perspective to actually be in a really good position today.
Bob, one of the things that you've been writing about at Mackay Municipal Managers is what you referenced to before is a return to the old normal. So what is the old normal that we're returning to in the municipal bond market?
Yeah, I think the old normal just refers to how the municipal marketplace over a historical period of time behaved. Prior to the pandemic and prior to the great financial crisis, state and local governments kind of had to handle their own finances and budgets on their own. They didn't have a lot of support from the federal government. Where the economy went, they went. So they had to be a little more prudent, so to speak. And the marketplace differentiated those credits that were prudent versus the ones that were not. And we think we're going back there because the federal government is pulling back those outlays. An A-plus rated bond should trade drastically different than an A-minus rated bond. As a matter of fact, an A-plus rated bond in a high tax state should outtrade an A-plus rated bond in a low tax state. Think about tax complications in our marketplace. So these are all the nuances, right? When you're talking about the municipal marketplace and relative value and opportunities, and you are starting to see this already. You are already starting to see credit spreads widening out. As an example, high yield in the municipal marketplace, lower investment grade and high yield, has outperformed pretty consistently since the early stages of the pandemic when the economy recovered. through the second quarter of this year. The second quarter of 2025 was one of the first quarters that high yield underperformed. And so we believe that's the beginnings of the marketplace starting to differentiate and say, hey, am I getting compensated to take on, am I getting risk-adjusted returns and yields to take on the weaker credits? And if not, I'm going to hold back and wait for better spreads. And that's the environment we believe is going to exist in the municipal marketplace for the foreseeable future.
And which states are the strongest, or what kind of issuers do you think will have the best credit quality and therefore will perform the best?
The more populated states tend to have higher credit qualities. Think along the lines of Massachusetts, New York, California, Texas, all very well-run states, very sophisticated systems for tracking their revenues and expenditures, and they have broad economies, broad diversified economies. They're going to do very well.
So for individual investors who invest in municipal bonds anyhow, what kind of yields are we talking about?
It's kind of all over the place. If you think about the supply-demand characteristics that have hit specifically in 2025, it had a very, very large impact on what's called the shape of our yield curve. That is yields attainable from 1 year all the way out to 30 year. And it has steepened drastically, meaning yields on the short end have come crashing down a lot. Yields on the long end have actually risen because we've had a lot of supply on the long end, far more than on the shorter end. And so it's really gotten steeper. And so as an example, if you are looking at a high-grade 5-year municipal bond, you're only looking at a 2.5% yield. Not really great. The 5-year treasury today is probably around 370, 375. So fully priced in our opinion, on that part of the yield curve. But the further out the yield curve you go, you don't have to go all the way out to 30 years, but if you can get out to say 20 years in the investment grade realm, you can pretty easily attain around a 4% tax exempt yield. That is very compelling because that is a tax exempt yield. On a taxable equivalent yield, depending on exactly which tax bracket the investor is in, you are typically 6% or higher depending on exactly which state you're in. And that is a very, very compelling story to tell.
And that's quite different than it was.
Yes, 2 years ago when I spoke to you, it was a much flatter yield curve. Today, I think we would say the sweet spot of the yield curve is probably between 15 and 20 years.
Okay, so that's a lot farther out.
So it's
right.
a little further out. Yes, exactly. There's smart ways for clients to kind of like add munis to a broad fixed income portfolio, right? So if you add short taxable versus 15 to 20 year tax exempt munis, your overall combined interest rate risk, duration in your portfolio, and your after-tax income streams are far superior, in our opinion, than if you just took a whole yield curve approach across both markets.
So what are you doing at Mackay to take advantage of what you're seeing is, again, this differentiation in the market between stronger financial issuers and weaker financial issuers?
So if you think about it from 30,000 feet, even if you don't know anything about the municipal marketplace, if I just explain to you, well, maybe the economy is going to slow down and credit spreads are kind of tight and everything is, I'm not going to use the term price for perfection, but there's not a lot of assessed risk in the marketplace. Under that scenario, what would you do? You would quality up your portfolio. You play a little bit of defense, especially with regards to credit. And that's exactly what we're doing here at Mackay Municipal Managers over the last year or so. And I'll give an argument, absolutely, we were a little early on this, but that's okay.
Bob, it appears that the economy is slowing down a bit. How do munis fare if the economy does slow down?
This is where munis actually shine. And so if the economy slows down faster than markets anticipate, you're probably going to have, on the margin, a flight to quality. That is, investors getting out of risk assets, going into riskless assets, predominantly treasuries, bonds in general, municipals in particular, that they will basically invest in. So if the economy slows down a little faster, they're actually going to get the benefit of demand feature in and of themselves. But that makes sense because they are so resilient. The municipal marketplace, from a fundamental credit perspective, the market does not need a really, really, really strong economy. They just need a stable to muddling economy. So if it slows down too much, then yes, they're going to have to balance their budgets and work on that. But when you're looking at it, there's a reason why default rates in the municipal marketplace are substantially lower than the corporate marketplace. That is not going to change anytime soon. Didn't change during the pandemic, didn't change during the great financial crisis. So I think we've thrown a lot of risk at all the markets, and we've tested this theory. It's going to hold up again. And so that is why we've always explained to clients that the municipal marketplace, from an allocation perspective, is a great place for a late cycle asset class. If the economy does start slowing down, this is a great way to maintain that income stream, which is very attractive, but also protect yourself from any kind of risk asset kind of spread pressure that may arise.
You are an active bond manager. One of the most popular products in the bond market in general and in munis as well are municipal bond ETFs. You think they're dangerous. Why?
ETF as a wrapper in and of itself is not dangerous. I think how our marketplace is managing them and manufacturing them. As an example, I'm an active opportunistic money manager, as you pointed out. Whenever you're talking about a liquid product, like an ETF, that invests in at times a less liquid asset class, the money manager, the investment advisor, has to pay particular attention to that disconnect. So your index ETFs don't have cash positions in them. Why? Because that increases their tracking area versus their benchmarks, so they stay fully invested all the time. So when redemptions hit those, they are forced sellers. We call them indiscriminate sellers. When cash flow is coming in, they're chasing the marketplace again. They don't sit on cash for a while and wait for a better opportunity. They just put the money to work in whatever they possibly can, whatever meets their index qualifications. That is why if you look at some of the large index municipal ETFs in our marketplace, even though they have virtually zero expense loads, they never outperform their benchmark and they have pretty horrible yields. I do like active ETFs. ETFs are easy for investors to execute and to actually get into and out of the marketplace when they want to. And if you're in an active one, that active money manager is helping you insulate from the timing issue. Liquidity is always the biggest concern in the municipal marketplace. It's actually not credit. If you have a good credit team, you can control credit. It's within your control. Liquidity, you just have to pay attention to every single day. So with ETFs, we do believe they're going to continue to grow in prominence in the municipal marketplace, but we also believe that it's also going to continue to differentiate. There are more and more active ETFs in the municipal marketplace. It hasn't been huge in our market without question, because that's not really what our market is all about typically, but we think they're going to get more and more important and larger with respect to investors are asking for it, right? It's an easier solution for them.
Do you have active ETFs, active municipal bond ETFs at Mackay?
Yes, we have 3 active ETFs today that we launched several years ago. They have a very good track record so far, and they were developed when clients came to us and said, you know what, do you have a solution for this problem we have? And so that tends to be what we do here at Mackay Municipal Managers.
So how do you overcome the fact that you're still, municipal bonds are still not a super liquid product, and you're dealing with that ETF wrapper, as you said, that people can trade like a stock?
First and foremost, and we can utilize this in our mutual funds as well. I have a cash reserve, 3 to 5% cash reserve in my mutual fund every single day. If heavy redemptions hit, I am not a forced seller. Our team is not a forced seller in the marketplace. Keep in mind, Consuela, if I am a forced seller and I'm getting hit with redemptions in the municipal marketplace, every single one of my competitors is also getting hit with redemptions and is selling. That is the worst possible time you want to sell. And so our mutual fund has cash reserves.
So at Mackay Municipal Managers, you always have cash reserves in your mutual funds, and you also have them in your active ETFs?
We do. So we keep a cash reserve to not only protect ourselves not to be a forced seller, but also to actually bid and buy bonds when all of our competitors are selling. Some of our best opportunities have always been when our competitors have to sell.
I'm an individual. I have a municipal bond portfolio now. It has probably not done great over the last 3 or 4 years. What is the outlook for me now? Is it going to be better? Are my returns going to be better?
your returns are going to be better for the simple fact, and I'll use the yields that we were talking about earlier today. You are starting at a framework of, say you're in a 20-year bond portfolio, you're starting with a 4% yield, tax-exempt yield. That is helping you considerably. It's twice as great of a yield as you had 3 years ago. And so that is a much better place to be. But clients have to think about this. If you do have a municipal bond portfolio that hasn't been looked at and turned over and reimagined, I'll use that term right now, over the last 3 years, it's probably stuck in that 1 to 2% yield world. You probably have some rather substantial capital unrealized losses in the portfolio that you could probably use, especially a year like this year when stocks are doing so well. Harvest those losses. Sell those bonds that are at a loss, reset them at higher yields, and you're now attaining and getting into that 4% accrual rate on a compounding rate, which is incredibly important for clients over the long term. Right. But at a minimum, think about your municipal bond portfolio from an active approach and what is going to set it up for you going forward for the next 3, 5, and 10 years into a better position.
Bob, one investment for a long-term diversified portfolio. Is there a municipal bond product or issue that we should all own in a long-term diversified municipal bond portfolio?
There is one that does come to mind, actually, and it's one that most clients are underweight, significantly underweight, and they are insured wrapped bonds, financial guarantee wrapped bonds. So think about it as buying a municipal bond with belt and suspenders. The reason why I like it today is because they're very, very reasonably priced. It's the equivalent of buying car insurance, health insurance, life insurance when you're young, you're a good driving record, and you're healthy. You want to get insurance then because it's going to be really inexpensive and it just covers you. Same case can be had today in the municipal bond marketplace. Wrapped insured bonds don't cost that much to attain an extra layer of credit protection for you. So you pick up liquidity, you pick up credit protection. If we eventually do slow down to a faster degree and we do have a slowing economy and credit spreads do widen out, that insurance will pay off handsomely, we believe, to clients because everything else is going to widen out in credits. They won't as much. And so you maintain a lot of liquidity and credit protection. And I think you're doing it at a time when the premiums to do that, to pay for that insurance policy, is very low.
And I think you told me that there were two major municipal bond insurance companies, Assured Guarantee and Build America Mutual. Is that right? So are those the two?
Those are the two that are left in the municipal marketplace. Assured Guarantee was around, but most of them disappeared during the Great Financial Crisis. It's important for your viewers to understand, though, most of those firms had troubles away from the municipal bond portfolios. It's the diversification that they were kind of forced to do at the time to get into that, but they're very strong, they're very resilient today, and there is a lot of value in these type of bonds that if you look at the size of the marketplace, it's substantially smaller today than it was back before the Great Financial Crisis. And given the credit cycle, given credit spreads, given the outlook and all the uncertainties that could possibly hit the marketplace, that is a very attractive option for clients to think about adding to their municipal bond portfolio.
Really interesting idea. Bob DiMella, so great to have you on Wealth Truck again. Thanks so much for explaining the changes that have occurred in the municipal bond market. We really appreciate it.
Appreciate you having me again. Thank you very much, Consuelo.
At the close of every Wealth Truck, we try to give you one suggestion to help you build and protect your wealth over the long term. This week, we are asking Bob DiMella to share the best investment advice he has ever received. Bob DiMella's action point is take a contrarian approach.
I think investors should try to take a long-term, rational, thoughtful approach to investing. What you want to do is you want to strip out the fear and the greed factor that comes into the marketplace, because reacting to either fear or greed is going to cost you and cost you dearly over time. And as a matter of fact, I'll almost flip the switch on it. Be contrarian. Take the fear and the greed to your advantage and do the complete opposite. Have a disciplined approach to it long term and If the herd is going in one direction, go the other direction as a general rule. Now, those are in times of extremes. Most of the times the markets are normal and rational and there's not a big consensus move in one direction. But when those time periods happen, those tend to be the pivotal inflection points of the investment universe that normally doing a contrarian view tends to pay off well from a risk-adjusted basis.
Being rational, thoughtful, and having a long-term investment horizon is indeed the opposite of today's reactive trading market. Next week, Barron Opportunity Fund's top-rated portfolio manager Michael Lippert assesses the investment potential and risks in the AI-driven tech boom. Please follow us on Facebook, X, and our YouTube channel. Thank you for spending time with us. Have a lovely weekend and make the week ahead a healthy, profitable, and productive one.